The reason I really have focused on value is because the trajectory of my life has taken me through a whole host of different seats around the table. And I think where you stand depends on where you sit for a lot of this conversation. And so my background actually is in community work and social work. And I started as the founder of the Larkin Street Youth Center in San Francisco, which works with homeless kids and teenage prostitutes, and is a very successful multi-service center program. But at the end of my 20s, I had to kind of recognize the fact that I had bought into a lie, right? And the lie that I had bought into was that social workers are about changing the world, right? And the fact is, the way that we've structured the nonprofit sector and our understanding of social value and impact has less to do with impact and a lot to do with politics, perception, and persuasion. It has to do with basically saying to folks, intent is impact. And we mean to do well. We've created this whole area of work to do good in the world, and yet we're not really going to drive performance metrics into our capital allocation decisions within that space. The reason that one nonprofit gets more money than another oftentimes has more to do with their ability to schmooze politicians and work the system, give a good site visit to a program director where you make sure that one of your kids comes up and engages them in a very deep and meaningful conversation, and then you get a big grant, right? And there was something just wrong with that for me. And so I basically burn out in that role, and through a number of kind of parts of the journey that we could talk about over whiskey sometime, I ended up working for George Roberts, who's the founding partner of Kohlberg Kravis Roberts, the leveraged buyout firm. And George had a different career track than the one I had chosen, and had a similar issue. And his issue was, as a business person who had really created his wealth through free enterprise, through the market system, he had a certain way that he thought about how you do business, how you manage assets, how you invest, how you create value in the marketplace. And he's a generous guy and wants to be helpful philanthropically, but a lot of the philanthropic conversation just did not engage him on any level. Because, again, it was, there wasn't a logic to the allocation of capital. There weren't formal metrics to be able to tell whether or not you're moving forward or back. And it just was not a very compelling kind of value proposition to invest in. And so I spent then 10 years working with George, running a fund with, we took philanthropic capital and invested in market rate businesses run by nonprofit organizations to employ formerly homeless people. And so we were like right in the middle of this conversation in the 90s as a lot of this, these ideas started to get traction. And I kind of found myself, and we'll talk about the SROI work in a minute, but found myself basically trying to take business ideas and acumen and practice and drive it toward community good and impact. And I found myself giving presentations at mainstream for-profit social investor sessions on this issue of how do you track social performance and value. And this is 10 years ago, 12 years ago, was kind of shocked that these folks who presented themselves as for-profit investors in social something had no way to describe the nature of the value they were creating through their capital allocations. And so I started moving further and further away from traditional philanthropy and more toward market rate investing for multiple returns, and ended up working for Generation Investment Management out of London, which is the global public equities fund that was launched by Al Gore and David Blood, $6 billion fund, and then ultimately working for a fund of hedge funds group. And as I kind of moved through these different stages, I realized that, well, my career as a social worker had gone horribly astray. That was one thing I realized. And I also realized that the reason that I could play through these different spheres or these silos or whatever you want to describe them as was that I honestly am agnostic about structure, right, and about the vehicle. Because over time, I've just developed this real idea, passion around that it really doesn't matter if it's for-profit or nonprofit or if it's philanthropic or market rate. The focus needs to be on understanding what's the value we're trying to advance and create, and how do we really create a set of investment instruments and organizational forms that can capture and maximize that value over time. And so all of which really has brought me to focus on the notion that, really at the beginning of the day, there's just two questions, right, for any of us. And I say, at the beginning and at the end, because I think when we were kids, we actually knew all of this, right? And what happens is, the older you get, the more it gets beaten out of you. And when you're a kid and you get like a lollipop, and you're like, this is great. And you're like, this is worth a nickel. I spent my nickel on my lollipop, and this is great value for the nickel, kind of thing, right? It's all kind of mushed together. And when you die, and you're looking back over whatever number of years you have to work with, I doubt you're going to sit there and go, wow, I made a ton of cash, right? And that's the measure of worth of your having lived. I think the measure of worth of your having lived will be some combination of what you've created in the world on economic, social, and socioeconomic terms and with an environmental kind of overlay, and that's really the point. And so as we stop for a period of time and reflect on what are we really doing, the fundamental question is, are you and your assets really maximizing your full potential value? And are all of your assets aligned strategically to achieve the goals and the impacts that you want to have over the course of your life? And so starting to like zero in more on the capital and the asset management side, we have to start then talking about fiduciary responsibility. So what does it mean to manage capital? What does it mean to have the responsibility to allocate funds in certain directions? And I think it's interesting when you listen to people talk about fiduciary responsibility, because a lot of times the conversation begins and ends with financial responsibility for maximizing the financial performance of the capital under management, right? And the duty of the fiduciary is to put capital to its highest and best use and generate more capital so you can have more money to go do more things with, right? And the fact is, the concept of fiduciary responsibility has evolved significantly over time and is continuing to evolve. And in fact, in the state of New York, there was a time where trustees were not allowed to invest in any other product or vehicle other than, wait for it, bonds issued by the state of New York, right? You were not allowed to invest in real estate, no direct corporate investments, I mean, none of this. And it was really the fiduciaries, the trustees, who came back at the regulators and the attorneys and all this stuff and said, basically, that's not right, right? We have a broader responsibility